Hi everyone, it's Miguel again with another video in my series 10 Common Wall Street Misconceptions. The misconception that we're going to address today is that earnings reports tell you how fast a company is growing. So to start off with that, before I delve into the whole business side of investing, I want to start with a personal anecdote just so that you get an idea of what numbers you're going to be looking at. So as I stated before, in my last video, I talked about The Millionaire Next Door, which was a book that basically said that if you really want to be on a millionaire track, that most millionaires end up following two principles that allow for them to make as much money. The first one is that they save about 10% of their income and they pay themselves first. The second principle is that they usually only eat out about once a week. So as long as you're doing that and you do that for a long period of time, you are actually setting yourself up to be able to reach $1 million status, which is something that a lot of people want to achieve, but they usually don't end up doing it because they eat out all the time or because they don't know how to save or whatever it is. But even when they save, they don't put their money into the right places. So a lot of people will judge fundamentals or the health of accounting statements based off of earnings reports. Now, earnings reports also report a number known as net income, and what they tell is it's essentially the paycheck of a business. But I'm going to break it down on a personal level and then explain how you can connect it to the business level. So to start off, if you're going to save about 10% of your money, this is what's going to be on your income statement, also known as a net income statement for corporations. You're going to see that there's income and expenses. Now, for most people, they have money that goes into their income. They spend the majority of it on expenses, and then they're really not left with anything else. The money comes in, and then it goes out. But if you actually manage to save that 10%, and you have about 10% that you trail off each month to your assets, then you're actually going to be able to have a lot more financial freedom than people who do not. That even though the majority of your money will still be going to your expenses, you won't have to live paycheck to paycheck because you're actually going to be growing your net worth, which is measured through a balance sheet. The net worth of an individual or of a corporation is measured through the mathematical equation assets minus liabilities equals equity. And that's how you calculate your net worth. A lot of people might be millionaires, or they might already be making a very high lifestyle because of how much money they make each month. But if they don't save that money and put some of it into investments, then they're still living paycheck to paycheck, and they're still going to be in major jeopardy if they end up losing their job or if something happens to where maybe they can't work for a couple months. So it's also going to be just as important to establish a good emergency fund, because that's going to make sure that you always have cash on hand. And the way that the emergency fund is referred to in the business world is the free cash flow statement. And the free cash flow statement basically looks at money they make from operations, money they make from financing or taking out debt, and money that they make from investments. And most people end up making their money through one of those three ways as well. You'll see that it's broken down through operations, financing, and investment. And those are really the three ways that you have cash on hand. So when we're talking about the individual level, you're going to want to set up that emergency fund with about 3 to 6 months of liquid income. That ensures that if anything happens to you, or maybe you end up going and job searching for a few months, or you move out into a new area, that will ensure that you actually have the ability to move with the job market. And because of the fact that we've seen such chaos exist in the real estate market, it's going to be a huge part of being able to make you money, the fact that you can actually move with the jobs and that you're not going to be stuck or have to miss out on opportunities because you don't have that proper emergency fund set up. For business, they also have liquidity concerns, and that's what the free cash flow statement measures. It measures their ability to actually have enough cash on hand to meet their obligations. As we saw in 2008 and 2009, a lot of real estate corporations crashed because they might have been taking in money, they might have even had a lot of assets on the balance sheet, but they were all properties. They didn't actually have the money necessary in terms of the cash on hand to ensure that they'd be able to pay for the upkeep of their properties, to pay for all the things that came with that. So if you're trying to get your personal finances right, you want to make sure that you're trailing off about 10% of your income each month into an investment account. And I would start by fueling your emergency fund first. And then once your emergency fund equals 3 to 6 months, then you can start investing. But I'm also going to break down these numbers based off of the size of a corporation, because what a Procter & Gamble is making, you're going to want to look at different metrics than, say, the new quick startup out of Silicon Valley that just had an IPO. So I would say that there are really 4 breakdowns of how much a company is worth based on their trading value. There is a micro cap, small cap, mid cap, and large cap. And each one is predicated upon the size of their market capitalization, but I'll start with the smallest first and then work my way through. So to start with micro cap, usually the biggest thing that you want to look at, hold on, I'm doing some research right now. All right, anyway, with a microcap business, the thing that you want to be looking at is for sales growth, because the first test of a business is, can they move their products and services? They might not necessarily be profitable yet, they might not have a lot of cash on hand, but the biggest test for an extremely small business is, can they move product? Can they move inventory? Is there actually a demand? And usually, if they pass that first test of being able to move product, they'll usually move to the second test, which is their ability to retain that income. They might be able to sell their products like hotcakes, but if they can't actually ensure that that's being reflected in their net income statement or their earnings report, then they're losing all that money on quarterly expenses. So the biggest test for a small cap is, do they have the ability to increase their net income or increase their paycheck? However, when you turn on CNBC, when you turn on a lot of places where they'll be giving any kind of financial news, even when you look up some articles on Bloomberg, so many people only stick with the income statement when that's probably not the easiest number or the most accurate number to monetize profit with. Because income usually is a lot more volatile based on different accounting shenanigans that can occur. A company could actually inflate their income if they were to, say, not pay off their expenses and kick them down the road. They would still be listed as a liability, but it wouldn't be listed as an expense because they didn't incur the expense yet. If they take out debt, it'll be reported on the balance sheet, but you only incur the debt on the quarterly expenses when you actually pay it off. So corporations will actually look more profitable on the income statement by kicking debts down the road, which is why you actually want to look at their long-term debt and their still outstanding debt by looking at net worth. And usually a company won't be able to have a high net worth until they've been able to pass the test of moving products through their sales growth and increasing their income through the check on their earnings. The third question is, how are they actually able to increase their net worth? And you measure that through assets minus liabilities. Everything a company owns, subtracted everything a company owes. The money that's left over is the amount of cash that a business would create for an investor if they were to close their doors tomorrow. I like to think of it as the actual opportunity cost of the business's own existence. And because in finance and in economics, I believe that really the most accurate ways that you can measure anything is always by checking it against its closest opportunity cost. That the net worth is really, in my personal opinion, the most important indicator, but it's going to be the most accurate for companies that have already shown that they can grow their sales and can grow their income. But when we look at large cap, when something grows to be so huge, for example, Procter & Gamble, that they usually have their best days behind them. And that means that they're not going to be able to grow their sales, to grow their income. They've already saturated the market and taken up a significant amount of market share. But what they can do is increase their cash on hand. And the more cash they have, the more dividends that they can pay out. Most companies don't pay dividends until they achieve that blue chip status to where they've grown so big that it only makes more sense to pay their profits back out to investors than to continue to retain it and try and find more ways to build it. It's like McDonald's. You can only build so many more McDonald's before you're just losing money building a McDonald's next to a McDonald's next to a McDonald's. So what do they do with that extra cash? They pay it out to their shareholders. And because those are usually large cap stocks, I would say that the free cash flow growth is going to be the most important metric because it measures their ability to grow their cash on hand to turn around and pay them for dividends. So if you wanted to write this down, I'll hold this up for a few seconds and you can pause the video. But it breaks down the growth classifications as a company goes through the cash conversion cycle. That first, they're going to want to put in the work to move their product. Secondly, they're going to want to increase their paycheck. Third, increase their net worth before finally increasing their cash on hand. And once they're able to sell product to increase their paycheck that they put towards their net worth, that allows for them to grow their cash on hand, that's the completion of the cash conversion cycle. That corporations are tested upon their ability to take cash and put it into more cash or create more cash from it. And because there are so many different metrics that you can look at, which I personally didn't even cover all of them, but I think that those are really the most important numbers for each one of those classifications, that just because you hear a company has had a great quarterly statement that shows that their earnings report has jumped so much, you really want to make sure that you also look at the other possible statements to make sure that the entire picture is okay. On a personal level, you also want to make sure that you're putting in the work, that you're actually making a good amount of money on your paycheck, growing your net worth, and building cash. And the only way that you can do that personally is by taking each step of the cash conversion cycle, breaking down where your biggest issues are, and then addressing them with the idiosyncrasies that you're going to require in order to properly target the greatest deficiencies that you have in the cash conversion cycle. Thank you again for watching, and I hope you all stay tuned for the rest of my videos. Thank you.